See, one common theme which is there in this entire syllabus of SFM is the theme of valuation. Throughout our syllabus of SFM, we will like to value. We will like to value a bond, a debenture, a share, futures, options. And now we want to see how we can carry out the valuation of a business. Why? Why are we so much interested in valuation? The reason that why we are carrying out valuation is because we want to know what is a fair price. What is the true worth? This is the reason that we are carrying out the valuation. Let us say you are interested in buying some company. Let's say you want to buy out a company A Limited, right? You can very easily, let's say it's a listed company, so you can very easily find out what is its market price. Let us say the share is trading at 60. We also know that it has issued 1 lakh shares. If I multiply the two, I am getting 60 lakhs. So the price that you will have to pay to buy this company is 60 lakhs. But is this price a fair price? That is the question. 60 lakhs you cannot say is the value of the company. 60 lakhs is the price that you will have to pay to buy that company. You get my point? If you are out for shopping, if I take a very simple example, if you're out for shopping, let's say you want to buy a new jeans, you are looking at the price tag. Price tag does not refer to value. You look at the price tag. The price tag of that denim, let's say, is 1500. That does not mean you will immediately rush to the billing counter, pay 1500 and buy it. No. After having seen the price tag, you will ask yourself, is it worth the price? Is it worth it? And that worth it is nothing but the value that you are determining. After looking at the price tag of 1500, it's quite possible you will not buy it. It does not mean that you do not have 1500. It doesn't mean that. You have 1500. Maybe you are having a lot of money in your wallet, but you are shopping for value. We are talking about value for money, and value for money is something that we can do only when you distinguish between the two. Many a times we are not able to distinguish between what is value and what is price. You have to first learn to distinguish between the two. Understand? Price is what you pay. Okay? And value is what you get in return. After you have paid the price, what will you get in return? That's what we refer as the value. Another thing, price is universal. Universal means it is same for everyone. Price does not change. Price is the same for everyone. Value is subjective. It keeps on changing from person to person, right? What I feel is valuable, you may not feel it is that much worth. What you feel is very valuable, for me it may be worth less. So value will keep on changing from individual to individual. Price cannot. As I was giving you the earlier example, the share is trading at 60 rupees per share. It is 60 rupees for me, it is 60 rupees for you, it is 60 rupees for my neighbor, also your neighbor, it is 60 rupees for your friend, it is 60 rupees for the entire country. But the value will keep on changing. I may feel that the share is undervalued, you may feel the share is overvalued. So valuation is an exercise that will be carried out by an individual, and depending upon the way the valuation is carried out, the value will keep on differing from person to person. But that cannot be said for the price. The price will remain the same. Let's think in this way. We know now that the movie theaters have opened, isn't it? Who is really taking that much of risk? I really do not know. But just think for a moment that a new movie is released. You were tracking this particular movie before the COVID times. Before the COVID times, an announcement of the movie was made, and you were really excited about it. But because of the COVID and all those things, right? We know that the movie theaters have remained closed for a very long period of time. You are a movie buff. You have been missing movies since long. And finally, this movie is released in the theaters. We know the theaters are operating right now at 50% capacity. I'm sure that things will keep on getting relaxed as we will be progressing ahead. So this new movie has released in the theaters. Okay, the price of the movie ticket, let's put it in this way. The price of the movie ticket, let's say, is rupees 250. And we just want to know what will be the value. As I said, you are a big movie buff. You have been tracking this movie since long, and the price of the movie ticket is 250 rupees. You pay 250 rupees, and with all the precautions you watch this movie, it's very much possible that you enjoyed the movie like anything. You enjoyed the experience of watching it again in a theater, perhaps even more. Quite possible that the value for you is, let us say, 350. So by paying 250, you got something in return which is worth 350. You get my point? But let us say I am not such a big movie buff. Okay, even if the movie ticket price is 250, I may not watch this particular movie, right? The value that I'm getting from 250 is less than 250. Quite possible that even if you pay me money, I might still not be interested in watching that movie. You get my point? The point that I'm trying to make is that price is the same. 250 rupees is the price of the movie ticket for you also and for me also, right? It's not actually changing. We are standing in a queue to buy a movie ticket. The person at the desk sees you, says, okay, 250, and then sees me and says, okay, for you it is 500. That is not so. The price of the movie ticket will remain the same, but the value derived will keep on changing. So this is the value for money exercise that I now want to carry out for a business. I want to do the valuation of a business now. Now, whenever you are doing business, the principle that you will apply whenever you do valuation, the principle that we apply is principle of future economic benefits. This is the principle that we apply. Principle of future economic benefits. If you buy a business, ask yourself, what shall you get in return? If you are buying a business, what shall you get in return? Ask yourself, what will you get in return? Let us say there is some running business. Let's say you are a pharma company and you buy another pharma company. You are planning to buy another pharma company. So I just want to know that what is the fair price for buying this new pharma company. So for that, I want to carry out the valuation. So I'm asking myself that if I buy this new pharma company, what shall I get in return? Tell me, what shall we get in return? Now, what we will get in return is the productive assets of that particular company. And these productive assets is generating cash flow. See, this is FM, right? Everything at the end of the day boils down to cash flows. So we are going to get in return the cash flows. By cash flows over here, I definitely mean cash inflow. So you buy that pharma company, you will be able to now, right? You will get hold of the productive assets of that particular company. Now, whatever is that company's sales, that is within your control. And that's how you will be able to control the cash flows. So the principle of future economic benefits suggests that, see, if you are buying a business, you are going to get in return the cash flow. So you know what is the value? You know what's the value? Value is present value of cash flows. That's it. If you are saying what is the value of business, the value of business is the present value of all future cash flows that are going to be generated. So just make a projection of the future cash flows that you will get. For example, if you are buying that pharma company, make a projection that after buying the pharma company, what shall be the cash inflows, discount it, find out the present value. Present value of all future expected cash flows will be nothing but value of that business. As simple as that. But you know what? It's very simple to say this, very tough to implement it in real life. You know why? Because business is a going concern. The moment we say we will do present value of cash flows, you are a bit like, yeah, something like this we were doing in capital budgeting. In capital budgeting, we were projecting the cash flows, we were discounting the cash flows, we were working out the present value. But then in capital budgeting, you are analyzing a project. Okay. A project has finite life. Understand this. A project has a finite life. So when I'm planning to do some project, that project may go on for 5 years, maybe 10 years, maybe 15 years, isn't it? Let's say you're planning to buy a new machine. In capital budgeting, we do this kind of analysis, right? We do replacement analysis where you are planning to replace an old machine with a new machine. And then we are doing the analysis that whether that replacement is making sense or not. So you are planning to buy a new machine. Tell me, what will be the useful life of a new machine? Whatever it is, ultimately it is finite, right? A time will come when that asset will get worn out. But this time we are not doing projection of cash flows for a project. We are doing projection of cash flows for a business. And remember, a business is a going concern. What do you mean by going concern? You can do business as long as you wish. There are companies who are recently celebrating 75 years of their existence. There are companies which are there in existence for more than 100 years, even 150 years. So you can understand the business can last for a very long period of time. I am planning to buy that another pharma company. Tell me, how long will I continue with the pharma business? As I said, it is a business that I'm doing. I will do this business as long as I'm making money. So if you're asking me that how long will this company keep on doing pharma business, it will keep on doing pharma business as long as that business is bringing money. So you are saying that you work out the present value of cash flows of a business, but business being a going concern will be done till perpetuity. And because I will do business till perpetuity, we are planning to project cash flows till perpetuity. As I said, easier said than done. You know, Earlier I was saying, okay, you want to find the value of business, make a projection of cash flows, discount those cash flows. Present value of the future expected cash flows is the value of the business. But now I understand the practical problem. The practical problem over here is that business being a going concern, you are asking me to carry out projection of cash flows till perpetuity. Simply not possible. Simply not possible. How can I do projection forever and ever? You get my point? So this is the issue. This is the practical problem which will be there. So what is the way out? What is the way out? I can't sit today and make projection for the next 100 years. So it's going to be very difficult for me. I can make a projection best for maybe 5 years, 10 years, maybe 15 years, isn't it? Even 15 years for a business is a very long period of time. So many things in business will actually change. And now, if you are saying that I will do this business for 150 years or I'll do this business for 200 years, tell me in the next 200 years, what will be my cash flows? Come on. It is simply not possible for me to accurately project the same. So, what is the way out? I'll show you the way out. The way out is that the life of business will be divided into two parts. Okay, I'll divide the life of business into two parts. The first one will be known as explicit forecast period. Okay, I will call it as explicit forecast period. Let's say it is EFP. And the second part will be period after the end of explicit forecast period. So life of the business should be divided into two parts. Explicit forecast period, period after the end of explicit forecast period. Question that arises is that what is explicit forecast period? Explicit forecast period is the time that will be taken by a business to reach a stable growth phase, right? We will say this is time taken to reach stable growth phase. If this is a business which has been recently launched, then this business will grow at a high rate for quite a few number of years. So maybe it's a recently launched business. I'm of the view that for next 10, 15 years, it will grow at a brisk rate. Then let us say 12 years. Then we can say that explicit forecast period will be 12 years. This is a business that was launched 4 or 5 years back, then perhaps the explicit forecast period will be 6 to 7 years. This is a business that was launched a very long time back. Perhaps you have already completed the explicit forecast period and you are in the stable growth phase. So this period after the end of explicit forecast period is nothing but the stable growth phase. We are making an assumption over here. See, when you are saying that I have to do projection for perpetuity, it will not be possible without making some reasonable assumptions. So the assumption that we are making over here is that, see, no business can grow at a high rate forever and ever. For example, let us say there is some company which is right now growing at 15%. If you are of the view that this 15% will be maintained till perpetuity, simply not possible. A business keeps on growing, becomes a huge one, it becomes a huge company, but then you always reach a saturation point. Once you reach a saturation point, I am not saying that the company will stop growing. Company will grow, but it will grow at a low rate. And this low rate will be maintained for quite a bit of time. So quite possible that the company is growing right now, let us say at 15%. So for 5 years, I'm expecting it will grow at 15%. Then for another 2, 3 years, I'm of the view that the growth rate will then fall to 10%. And then a time will come that from 9 to infinity, as long as it keeps on doing business, perhaps it will keep on growing at a stable rate of 6%. Getting it? So this 9 to infinity, this will be understood as period after the end of explicit forecast period, while the first 8 years will be understood as the explicit forecast period. You get my point? So till you don't reach the stable growth phase, explicit forecast period, once you are of the view that yes, now the company will grow at a stable rate, or maybe the company will not grow at all, right? That means the explicit forecast period has ended. You have entered into period after the end of explicit forecast period. Now, why are we calling this explicit forecast period? The reason why we are calling it as explicit forecast period is because for this period, you have to carry out detailed projections. Detailed projections of cash flow. Let's say you are saying that the explicit forecast period is 5 years. For example, let's say explicit forecast period is 5 years. Then for the next 5 years, carry out detailed projections of the cash flows. What will be my sales figure? What will be my operating expenses? What will be my all other expenses? Let's say administrative expenses, selling and distribution expenses. That's what you will do. You will work out what is the profit that you will earn, how much tax you will pay, work out the cash flow that will be generated. So for the next 5 years, if the explicit forecast period is 5 years, for the next 5 years, carry out a detailed projection of the cash flows and discount it and find out its present value. Getting it? So you'll do a detailed projection of the cash flows. You will work out its present value. So this will give me present value of cash flows in explicit forecast period. Detailed projections should be carried out, and on the basis of that, you should work out the present value of the cash flows. Okay. What will happen once the explicit forecast period ends? Once the explicit forecast period ends, you will enter the stable growth phase. When you enter stable growth phase, you will now calculate what is known as continuing value. Continuing value is also known as terminal value. It is also known as horizon value. This is what is to be determined. Once you enter the stable growth phase, now work out what will be the present value of the cash flows that will be generated till perpetuity. And whatever is that, whatever amount that you are getting, we will call it as continuing value or a terminal value or the horizon value. How will you get it? Okay, let's understand. How shall we get this? As I was saying, explicit forecast period is 5 years. Okay. And then you are entering into a stable growth phase, as I said. So we are entering into a stable growth phase. Let's take a simple example. Let's take a simple example right now. After 5 years comes to an end, we are of the view that the company will stop growing. So the stable growth rate is understood as 0%. Okay. So whatever was the cash flow of the fifth year, that cash flow of the fifth year will now continue till perpetuity. Let us say that cash flow, let's visualize for a moment that the cash flow is 1500 rupees. Okay, the cash flow is 1500 rupees. This 1500 is expected now till perpetuity. And I want to find out what will be its present value. Remember one thing. In FM, if there is any annuity which will continue till perpetuity and you want to find out its present value, you should take that amount and divide it by the discount rate. Okay, in FM, if there is any annuity that will continue till perpetuity and you want its present value, divide it by the discount rate. So you are expecting 1500 now forever and ever. Divide that by the discount rate. Let's assume for a moment that the discount rate is 15%. You will get the present value as 10,000. Yes, 10,000. So I'm getting the present value as 10,000. This 10,000 we will call as continuing value, horizon value, terminal value. Out of all the three, the most popular term is continuing value. So we can say continuing value is 10,000. What is this 10,000? Ask yourself, what is this 10,000? This 10,000 is year 6 till infinity, whatever is its present value. From year 6 till infinity, whatever cash flows will be generated, what is its value? That is the continuing value. Getting it? So once you get the continuing value, you will come to know what is the value of the cash flows for a period after the end of the explicit forecast period. Okay, let's take a different example now. Let us say it is not 0%. We are of the view that once we enter into a stable growth phase, our company will grow at 3%. Then what to do? Then how will I work out the present value this time? Earlier we were saying present value will be cash flow divided by discount rate. Okay, this time what will happen? This time a slight change. This time the present value will be, of course, the cash flow. This cash flow will continue till perpetuity. So I want to find out what is its present value. This time it will be divided by the discount rate minus the growth rate, right? Growth rate will be deducted. See, your discount rate earlier was 15%. That means you want 15% return. And now we realize that the growth rate is 3%. I want 15% return, but 3% return will be available to me because the cash flows will keep on growing at 3%. So effectively now I want 12% return. That's the reason. What I will do now here is I'll say 10,000. I'll say this is 15% minus 3%, right? So 15 minus 3, that will turn out to be 12. So 10,000 divided by 12%. Sorry, it was 1500, right? Just a second. Our cash flow that we are expecting is 1500. So I'll take 1500 over here. So 1500 divided by 12%. The present value this time is 12,500. Getting it? So if there is a growth rate, then find out the net discount rate. Cash flow should be divided by the net discount rate, and that is how you will get the present value. The logic is simple. Discount rate is nothing but the return that you want. Earlier, the growth rate was 0%. So I took 1500 and divided that by 15%. Right? This time, growth rate is 3%. I want 15% return, but 3% return will be available through the growth of the cash flows itself. So now I am concerned only about the balance 12%. And that's the reason I am discounting net by 12, and I get the present value as 12,500. So this is the continuing value. Okay. Now, once you get the continuing value, as we written over here, once you get the continuing value, you should find out its present value. So I'll work out over here present value of the continuing value. Okay. And I will add up the two. The total of the two is nothing but value of business. So you'll get the value of the business over here. Okay, so value of business will be present value of cash flows in the explicit forecast period plus the present value of the continuing value. Remember, the continuing value again has to be discounted. Earlier we were arguing, yes, this is one point that I like to explain before we move further. As you can see here, when we say 12,500, 12,500 is present value only. But this is present value from year. In our example, we were taking explicit forecast period as 5 years. So this is present value for year 6 till infinity. From 6 to infinity, right? So this is present value at end of 5th year. Get my point? It is at the end of the 5th year because it is representing year 6 till infinity. But when I calculate the value of the business, I want the value of the business as on today. So this is at the end of the 5th year. So discount it and find out how much it is as on today. So that's the reason I am saying that we should work out the present value of the continuing value, add to it the present value of the cash flows in the explicit forecast period, and the sum total of the two is the value of the business. Right? Before we wrap up the discussion in this episode, one more thing. We are saying cash flow, right? When we are saying that we will be calculating the present value, we are saying we will consider the cash flow. What is the nature of the cash flow that I will consider in business valuation? Now, if you compare this with capital budgeting, in capital budgeting, we were calculating what we call as CFAT, cash flow after tax. We use cash flow after tax in capital budgeting. But when you do valuation of business, we will not consider CFAT. Rather, we will consider what is known as FCF. FCF stands for free cash flow. For valuation of business, the final figure of cash flow should be the free cash flow. By free cash flow, we mean that cash flow which is freely available to the purchasing company for any purpose that it deems fit. You get my point? I am buying your company. How much cash you are generating? What is the benefit for me? The cash that is generated from your business, which I am buying, which I can use for any purpose that I wish to. That is the free cash flow. And it is that free cash flow that needs to be discounted. I'll give you an example. Let us say a company is generating a cash flow after tax. Let's say I'm buying your company and your company is generating a cash flow after tax of 2,500. As I said, your company right now is growing, let us say at 8%. to maintain this growth rate of 8%, I have to still make investment. Certain amount of cash which is generated from your business, it has to be reinvested back into your business. The business is still expanding. And because the business is expanding, there are certain investments that I have to make. So your business is generating a cash flow after tax of 2,500. But from this, I have to reinvest. Let's say I have to reinvest 1,500 rupees back into the business. So I will argue that my free cash flow is 1,000. Understand this. When I buy your business, the total cash generated is 2,500, but 2,500 will not be used for valuing your business, because out of 2,500, 1,500 will go back into your business. I am not getting benefit of 2,500 by buying your business. I am getting a benefit of this extra 1,000. So this 1,000 which is generated, that's the free cash flow. So when you value business, you do not consider CFAT. No, that's done in capital budgeting. When you value business, you will consider free cash flow. Now, there are two approaches by which you can work out the free cash flow. One is known as FCFF approach, that is the free cash flow to the firm approach. Another is FCFE approach, which is the free cash flow to equity approach. That's what we will be discussing in the next episode. I hope in this episode you have become clear with the framework for business valuation. What is the framework? Life of the business will be divided into explicit forecast period and period after the end of explicit forecast period. For explicit forecast period, carry out detailed projections of the cash flow. Now we know we will do detailed projections of free cash flow. Discount it, find out the present value. Once the explicit forecast period ends, you have to work out the continuing value. Also discount the continuing value. The sum total of the two will be the value of the business. And most importantly, as we realize towards the end, the cash flow that we will project will not be CFAT, but it will be FCF, free cash flow. As I said, in the next episode, we will discuss how we can carry out the projection of the free cash flow.